Have you ever felt like there are two different economies running at the exact same time? One where the financial markets are just rocketing upwards, and another where your wallet feels a little bit lighter every single day. Well, it turns out there's this powerful 300-year-old idea that explains this exact feeling, and it really gets to the heart of why the rich seem to get richer, especially right after a crisis. It's a really weird feeling, isn't it? After a huge crisis, like in 2008 or 2020, you turn on the news and see headlines about the stock market hitting all-time highs. But at the same time, you're at the grocery store or the gas station, and you can feel that squeeze. Prices are up on everything. So if it feels like you're living in a totally different economy than what's on the news, that's because in a very real way, you are. And economists actually have a name for this. They call it a K-shaped recovery. It's a perfect visual. The top arm of that K represents people who own assets, stocks, real estate, and you can see their wealth just shoots for the moon. But then there's the bottom arm. That represents wage earners, whose financial situation kind of stagnates or even gets worse. It's the perfect picture of that two-track economy. But here's the wild part. This isn't some new bug in the system. It's not a glitch from the internet age. The key to understanding this whole K-shaped world was actually figured out almost 3 centuries ago by an Irish-French economist who was just watching how gold and silver move through his economy. Right, so to really understand our modern world, we need to jump in a time machine and go all the way back to the 1730s. We're going to meet the man who first spotted this phenomenon, Richard Cantillon. He noticed something truly revolutionary about how money flows, and it perfectly explains the K-shape we're all seeing today. And here it is, the big idea, the Cantillon Effect. The concept is actually pretty simple at its core. It says that when new money is created, it doesn't spread out evenly, like butter on toast. Now, it's way more like pouring syrup onto a stack of pancakes. It pools in one spot first and only slowly spreads out. And that simple fact, who gets the money first, changes absolutely everything. Cantillon himself put it perfectly. The people closest to that money spigot, they see their wealth go up before prices have a chance to react. They get to spend all this new money while things are still cheap. But by the time that money finally trickles all the way down to everyone else, prices have already gone up. And so their ability to buy things, their purchasing power, it's been seriously damaged. Okay, so you're probably thinking, gold and silver in the 18th century, what does that have to do with our digital world of central banks and things like quantitative easing? Well, it turns out the principle is exactly the same. It's just that the path the money takes today is, well, a little more complicated. So here's how that modern journey unfolds. First up, a central bank creates brand new money, pretty much out of thin air, using a process like quantitative easing. Now, that money doesn't go to you or me. Nope, it gets injected directly into large commercial banks. So what do these banks do with all this new cash? They invest it. They buy stocks, they buy bonds, and that pushes asset prices way, way up. Only then, much later, does that money finally find its way into the broader economy, raising the price of milk, gas, and everything else. And this creates two totally different kinds of inflation that hit at different times. First, you get asset price inflation. This is fantastic news for the small slice of the population that owns the vast majority of these assets. But then later on comes consumer price inflation, and this affects everybody. But it especially hurts people who don't own those assets, who just rely on a paycheck to pay for things that are suddenly getting more and more expensive. And that delay, that crucial time lag between those two types of inflation, that's what splits the economy in two. It creates a very clear set of winners and losers. It is literally the engine that draws that K-shape we saw earlier. It's all about who's at the front of the line for new money and who's stuck at the back. So the winners are pretty obvious. The financial institutions, the big corporations, and the asset owners, who get to spend that new money while it's still cheap, boosting their real wealth. And the losers? Well, that's wage earners, retirees with fixed incomes, and anyone who's diligently putting money in a savings account. By the time the money reaches them, it's already lost value. They are stuck paying higher prices, which acts like a hidden inflation tax that quietly transfers wealth from the last in line to the first. And look, this isn't just a theory. History is packed with examples. Back in the 16th century, Spain got flooded with gold from the Americas. The Spanish crown and its connected merchants got fabulously wealthy. But massive inflation crushed the working class and helped cause Spain's decline. Fast forward to after 2008. Quantitative easing fueled a decade-long party in the stock market, while wages for most people barely budged. And in 2020, we saw the whole thing happen on fast forward. A massive surge in asset prices, followed very quickly by a surge in consumer prices. This brings us to a really critical debate. If the very way we create money systematically widens the gap between the haves and the have-nots, is this really the only way to run an economy? I mean, is it fair? Is it even necessary?
Now, to be fair, there are definitely counter-arguments. Some economists will point out that banks might just sit on all that new money, so it never really causes broad inflation. Others argue that, hey, if everyone expects inflation, they'll just demand higher wages and adjust prices right away, which would neutralize the effect. And then there's a very common argument that yes, this might cause some inequality, but it's a necessary evil to stop a catastrophic depression, like the one we were staring down in 2008.
But understanding the Cantillon effect naturally leads to a really fascinating question. What if we just changed where the money starts its journey? For instance, there's an idea called helicopter money, which just means giving new money directly and equally to all citizens. Or what if central banks use their power to fund productive projects like green energy or new infrastructure instead of just buying financial assets?
And so this leaves us with the ultimate question. The Cantillon effect isn't just some dusty old economic theory. It proves that the choice of who gets new money first has enormous, real-world consequences for wealth, for inequality, and for the very shape of our society. So the question really isn't just for economists, it's for all of us. If we have to create new money, who do you think should be first in line?